Good day. I'm Ayanda Mazwi, a Senior Assistant Ombudsman at the Office of the Short-Term Insurance Ombudsman. Today I'm joined by Peter and John from our office. Recently, the Ombudsman for Long-Term Insurance, referred to as OLTI, and the Ombudsman for Short-Term Insurance, OSTI, went into what we call a soft amalgamation. As such, we have collaborated under the banner of the Insurance Ombudsman to bring you this production. We did this again in our previous segment where we explained to you who or what the Ombudsman is and what the respective offices do. We also explained our complaints handling process, as well as issues around jurisdiction or the mandates that the respective offices carry. It may be worth your while to refer back to that recording if you have not already done so. Later on in this segment, you will be hearing from Sithandwa, Nikki, and Juvon from OLTI. They will discuss hints on funeral policies and credit life insurance. For now, I will be handing you over to Peter Nkuna and John Tennyson to discuss with you short-term insurance aspects. John will be giving you a case study on a very important topic, which is business interruption cover. Peter is going to have a discussion around motor vehicle insurance. I will now be handing over to you, Peter, to give us your presentation.
Thank you, Ayanda, and a good day to the viewers. I'm going to do a presentation on a real case study that came across my desk and that involved a motor vehicle accident claim. According to the insured, when reporting the matter to the insurance company, he was driving behind a truck, and from this truck fell a rock that caused damage to the windscreen and a glass sunroof on the vehicle. The insurance company considered the claim and decided to pay out only on the windscreen, considering the claim to be a windscreen-only claim, and therefore the insured only had to pay an excess in that regard. The rest of the damage relating to the roof of the vehicle was declined, and the reason for that was that according to the policy, the glass sunroof was not specified and therefore did not enjoy cover. When we investigated the matter, we looked at what happened at the time of the sale of this policy, mainly because the insured explained that he was not an experienced consumer and that he had bought the vehicle as it was with the sunroof fitted, and he did not know that the sunroof was not a standard accessory or that he had to specify it in order to enjoy cover for it. When we looked at the conversation, it was clear that when asked about any non-standard accessories that had been fitted, the insured firstly replied in the negative and questioned further about whether there is a radio and if that radio is basic or it's a special type of radio. His response was as follows: everything came with the car. I never fitted anything. I just bought it as it is and did not add anything. The car is standard. And from that, it was clear that his understanding of what is a standard or non-standard vehicle or what is standard or non-standard accessories was quite different from the understanding that the insurance agent ought to understand or pick up, and therefore should have prompted the agent to explain a little bit more and make sure that the insured understood what it is that he was required to do in order to ensure that he is adequately covered. One of the other things that we considered in making our decision was the following. If one thinks about how the incident occurred, a rock falling on top of a vehicle, it is quite clear that any vehicle, irrespective of whether it had a sunroof or a standard roof, would probably have been damaged. And from this perspective, therefore, the insurer was required to explain what difference, if any, was made or brought about by the fact that this particular vehicle had a glass sunroof. And some of the possibilities in that regard would be that if the vehicle had a standard metal roof, it would not have been damaged at all. Alternatively, it would have been damaged less. Another possibility is that because it was a sunroof made of glass, the damage became much worse, or whatever the case may be. And the insurer was required to explain if there was any explanation as to why it deemed it that the damage would not have occurred to the roof had it been a standard roof, because that did not seem to be supported by the available set of facts and circumstances. And it was on this basis that when a recommendation was made to the insurance company to consider settling the claim, the insurer considered that the roof would have probably been damaged irrespective of whether it was a standard one or the currently installed glass sunroof, and therefore this would probably have been a valid claim. And the fact that it happened to have been a glass sunroof was probably fortuitous and should probably then not be considered as a material fact. And the important take on this is that from a strict perspective, the policy does not provide cover where an accessory on the vehicle has not been specified on the policy schedule and would therefore not enjoy cover. So it was just on the basis of the peculiar circumstances of the laws that it was possible to make the argument that the insurer ought to consider settling the claim. And I think the lesson out of this is that people should not think that they do not have to specify accessories because the ombudsman will agree with them. It is an established principle of insurance that if you would like to have something covered on your motor vehicle and it is not part of the standard specifications of the vehicle, then that ought to be specified so that you can enjoy cover on it. Thank you.
Thank you, Peter. Thank you, and thank you for your presentation. I will now hand over to John Tennyson. He's going to give us a case study on business interruption cover, and perhaps we can also have an opportunity to ask a few questions just to clarify the issues around this very important topic. Over to you, John.
Good day, Ayanda. Thank you so much for the opportunity to present my matter to you today. The topic of my matter or my case study is at the heart of, or was at the heart of, a lot of litigation, uncertainty, and even hardship in recent times. This is obviously taking into consideration the COVID-19 pandemic, which neither the insured or the insurers actually foresaw. And for this reason, it caused quite a lot of controversy. I shall explain, or I will discuss one of our matters that is hopefully less complicated, because it does get quite complicated when you delve into the legal principles and so on, which were considered in the litigation surrounding the matters. I think just as important as to know when you do do have cover in terms of these policies. It is also important to know when you do not have cover in terms of these policies. So for that reason, I've decided to discuss a business interruption claim, which was brought in terms of a commercial insurance policy which had standard business interruption provided standard business interruption without any extensions of cover. The standard business interruption policy is normally a peril-based policies. You get two types of policies. This is very important to understand, by the way, because this will determine whether you have cover or not. You get two types of policies. You get policies that provide comprehensive cover, and then the cover is limited by way of exclusions. In most instances, such as the present one, the policy is what is referred to as a peril-based policy. What this means is that the cover provided in terms of the policy is defined in terms of certain events occurring that causes damage to your property. Therefore, an insured peril must operate, causing damage before the policy can respond. Now, what is an insured peril? An insured peril is an event that occurs that will cause damage to your property and which is specifically listed as an insured event in your policy wording. This is, for instance, lightning, let's say earthquake, fire, any of those perils. For instance, then, if your property is damaged by something which is not an insured peril or listed in the policy as an insured peril, there will be no cover because cover is not triggered and the policy cannot respond. Once one understands this principle, we can go ahead and discuss the claim at hand. What happened is the COVID-19 disease arrived on our shores, and government implemented lockdown, which we all know and we've all seen the effects of. One of the greatest effects is obviously that many businesses could not operate, and this is the case with the current claim. The insured had to close its doors, and obviously there was an interruption of business causing a great loss of income. The insured duly went to his insurer because he had a commercial insurance policy and in good faith intimated his claim for the losses that he encountered as a result of the lockdown. The insurer promptly rejected the claim. Okay, the claim was rejected by the insurer on the basis that no insured peril operated. Now, if you think back of what we discussed before, this means that an event did not cause the damage that the insured is claiming for, which is insured in terms of the policy. In other words, it's not listed as an insured event in the policy. I will discuss the policy wording quickly, very briefly. The policy wording in this instance indicated under standard business interruption cover that in the event that the insurer accepts liability for damages that occurred in terms of your different sections of the policy, which is, in this instance, it was company equipment, buildings, and one or two others. But then the policy goes further and says, so there has to be damage that occurred to some of the property which is insured in terms of, say, for instance, the building section of the policy, which caused you for your business to be interrupted. Okay, but then the policy doesn't stop there. It says that the damage that was caused to that insured property must have been caused by the perils listed in terms of the fire section of the policy. Now, if you go to the fire section of the policy, you will find a list of insured perils, and these are the standard perils that we find in almost all insurance policies that provide cover for fixed property. And this included earthquake, fire, storm, your normal insured perils. What was distinctly absent, though, was infectious disease, pandemic, or even lockdown. Okay, so if one takes into account the policy wording, it will have the following implications. There must have been damage to the property already insured by the insurer and the insurer must have said, we will indemnify you for that damage to your property. And once this has been established, you are then ready to intimate your business interruption claim, but only if your business was interrupted and obviously you suffered a loss. They will then check what caused your business to be interrupted, and if it is not damage to the building, for instance by fire, that prevented you from carrying on the business, there will be no cover in terms of the policy, because in actual fact, no insured peril operated causing the damage or your loss. Many insureds found this to be very confusing, but having considered the policy wording as well as the facts, we could find no damage to the building or any other damage as described in the policy as insured in terms of insured peril, and therefore we had no alternative but to agree with the insurer that there was no cover in terms of this policy for the particular claim. Many insureds are confused because they are of the opinion that they have business interruption cover, and therefore, as soon as the business is interrupted, they should be compensated. This case study will, however, demonstrate that not all business interruption cover policies will provide you with the cover that you think you have. And that's it from me, Ayanda.
Thank you, John. That was very informative, and you are correct. These types of matters can get very complex, and I think you gave a nice broad overview of the issues surrounding business interruption cover. The question that I do have, and I think that some consumers might want to know, is why should this claim not be settled, considering that the Supreme Court of Appeal upheld the judgment handed down in the Cafe Chameleon and guard risk matter?
Ayanda, I believe that's a very relevant question, and I think that has caused quite a lot of confusion with the public, because the courts on the one hand have now said that business interruption claims must be paid because insurers are incorrect. It is, however, not that simple. As explained to you just now, in terms of the policy, it must COVID-19 or the lockdown or infectious disease for that matter must still be noted as an insured peril in your policy. The big argument that went on and which went on litigation was how this should be interpreted to determine causation, but that is a completely different topic that we won't discuss at the moment. The thing is, as soon as your policy does provide cover for infectious disease or even pandemic or quarantine or the cancellation of bookings, then it is established that the insured peril operated to cause damage in the form of business interruption or loss of income, and then only do you have a claim in terms of the policy. The judgment does not provide a cover-all approach for all business interruption claims, and just to summarize, you must make sure that you have specific cover for infectious disease, COVID-19, lockdown. Lockdown is now considered, unanimous with COVID-19 as the cause of businesses being interrupted. But also, you have to have cover for a cancellation of bookings, for instance, which will also be affected by the current situation. So, yes, important to notice that in short, the peril, which is COVID-19 at the moment, must be noted as an insured peril on your policy.
Okay, thank you, John. I think it seems quite clear that not all commercial insurance products are the same, and in some instances you might find that the perils that you discussed are standard cover, or are they additional cover with an additional premium? Is that something that is easy to determine when you are taking up the sort of cover?
Ayanda, yes. Unfortunately, a business interruption insurance is quite abstract, or it could become quite abstract, which has been demonstrated by this whole pandemic, which nobody foresaw. So it's not easy to determine what additional insurance you might need for the future, because we don't have crystal balls that we can look into and It is, however, prudent to look at where there could be possible losses in future in terms of business interruption, and then make sure that the insurer disclose to you at the time that you purchase that policy every type of extension of cover they provide, in addition to your standard business interruption insurance. And that's probably true of all other sections of your commercial insurance policy as well. So in most instances, you had your standard business interruption cover and people thought that was adequate, but ignored the fact that there was additional cover that you could take out specifically for infectious disease. And many neglected to do that. And for that reason, they do not have cover for the losses incurred as a result of the pandemic.
Thank you, John. Thank you for that very insightful presentation. And I'd also like to just extend another thank you to Peter as well, where he presented the case study on motor insurance. For now, I'm going to hand over to the long-term insurance ombudsman. Have a great day further.
I'm Nikelwa Tolashe. I am from the Ombudsman for Long-Term Insurance. With me is going to be Sithandwa Tolashe. She's going to be answering the questions that I'll be asking with regards to funeral policies. Hello, Sithandwa.
Hi,
Please introduce yourself and tell us your role at the Office of the Ombudsman for Long-Term Insurance.
Okay, I'm Sithandwa Tolashe. I'm an assessor at the Office of the Ombudsman for Long-Term Insurance. I deal with complaints. We consider complaints. We then write to the insurers, the long-term insurers, for their responses. We then evaluate the matter and either settle it in favor of, we settle it, and or we do a ruling. Many of the complaints we get relate to funeral policies.
Okay, give us a short introduction on funeral policies.
Funeral policy, there are different kinds of funeral policies, and they are sold in many different ways as well. They may cover one life or a family, extended family. They are sold in different ways as well. They may be sold from you can buy it from the shop, you can purchase it directly from the insurance company, and you can apply through a sales agent and so forth.
Please advise on who can be covered in terms of a funeral policy.
Okay, a funeral policy may cover one person, and it may cover extended family. So that extended family would be your siblings, your parents, parents-in-law, and so forth. It's very important at application stage to disclose the correct relationship and provide a correct explanation of your relation or of the relationship, because that may determine that might affect the claim at a later stage. A funeral policy is not a savings account. Some policies have a savings element, but not all of them. You pay for the cover you enjoy every month, and should the policy lapse or be cancelled, you forfeit all the premiums that you've paid, because the premiums that were paid before the cancellation or the lapse were used for the cover. You were paying for the cover that you enjoyed.
Okay, so how does one know where to apply for the best funeral policy?
Well, you have to research, do a research, and try to get more information about the sales agent. You can get the information. Okay, you have to establish whether the agent is registered with the FSCA, which was previously known as the FSB. You can request the agent to provide you with their license number, with their license, and you just have to make sure that you're dealing with an accredited sales agent or insurer, and just be careful of scams, because there are a lot of scams. Of people buying policies from companies that are maybe not even registered with the FSCA.
Okay. Can you please give us a few hints for when buying a policy?
Oh, like I said, you just have to do your research and just try, if it's an application form, if you're completing an application form, just read everything, even the fine print before signing.
Please guide us on the actual application.
The actual application?
Yes, application for a funeral policy.
Okay, the application, well, the application, when you complete the application, you just have to provide the accurate information to the sales agent. You know, make sure that you give all the information. They might request certain documents, but they will let you know when during the application, when you do actually apply for the policy.
Is there anything that the insurer or the sales consultant might require from me when I'm purchasing or applying for the policy?
Not necessarily, but they will let you know if they need anything from you for the application of the policy.
So what must I pay to have the cover?
The sales agent will advise you what premium, based on the risk that the insurance company will be carrying. So it will depend on the people covered and how many lives assured and their ages and things like that. So it will vary. Yeah.
So what must I expect for once the application has been accepted by the insurance company?
The insurer will send you the policy schedule, policy document or policy summary, which you'll have to read, make yourself familiar with the terms and conditions.
Okay, so what are my rights if I'm not happy with the policy?
After the application has been accepted and the policy document has been sent to the policyholder, you have 30 days in which to cancel the policy if you're not satisfied with what's on the policy.
Can I nominate beneficiaries on the policy?
Yes, you may. You may nominate a beneficiary, and it's important that you disclose or you let a family member know about the policy so that they may submit the claim should you, as the policyholder, if you are covered under the policy, should you pass away.
Okay, how do I submit a claim in the event of a death of one of the lives assured?
The policy document will provide the details of the insurance company. You may contact the insurance company to let them know of your intention to submit a death claim. The insurer will request information or advise on what documents to be submitted in order for the claim to be assessed.
Do funeral policies have waiting periods?
There are no waiting periods for accidental death. There is a 6 months waiting period for death due to natural causes.
Okay, so what steps can I take if my claim is rejected?
If your claim is rejected, you may lodge a complaint with the Office of the Ombudsman. Our details are provided on the policy document. Yeah.
Thank you, Standa, for this valuable information, and I hope consumers will not have a problem for when purchasing the funeral policies, nor will they have problems when they are claiming at an event of a death. I am going to be handing this over now to Mrs. Yvonne Bernard-Theron, who is an adjudicator at the Office of the Ombudsman. She is going to go through the next segment.
Hi, my name is Yvonne Barnard-Theron. I am an assistant ombudsman at the Ombudsman for Long-Term Insurance. We investigate all kinds of long-term insurance complaints. An easy way to remember it is it's got to do with anything that you can't touch, like your life, disability, dread disease, retrenchment, those kind of things. I'm going to do a quick presentation today on credit life insurance. It's something that's come up quite a lot during the past year, especially due to Corona. I mean, it's the media is awash with articles that, you know, and everyone knows COVID-19 has had a devastating effect on our economy and on our health system, and we can see it on the complaint side as well. People's livelihoods were hard hit, and quite a number of people lost their jobs. From our side, we definitely saw an increase in complaints. We have, between 2019 and 2020, we've got about 78, almost 80 more credit life insurance complaints than we had in 2019. And considering just the cases that we closed for credit life insurance in 2020, about 240 out of the 322 cases we closed were due to the policies, terms and conditions that were not met. And this is specifically for credit life insurance complaints only. Okay, so what is credit life insurance? Basically, it's insurance cover on an outstanding balance on a credit agreement. So there's two agreements. You've got your credit agreement on the one side. This is for loans, for vehicle financing, credit cards, all those kind of credit. That's a separate agreement from the credit life insurance. So credit life insurance is usually added onto a credit agreement. It is insurance that covers the outstanding balance on a credit agreement. In terms of the policy, the insurer will either agree to either settle the full outstanding balance of the credit agreement or a portion thereof if an insured event happens. It would be either death, disability, critical illness, or dread disease, or retrenchment or loss of income. The main reason that credit life insurance claims are declined is because policy terms and conditions are not met. 3/4 of the complaints that we close is due to this. And then, of course, there's exclusions and policies that have lapsed due to non-payment. So regarding policy terms and conditions that were not met, like any agreement, like any contract, a policy is also a contract. It is an agreement between an insurance company and a credit provider, or you as the consumer, or both you and the credit provider. But again, like all other contracts, parties are bound by the provisions in the contract. So for a claim to be paid out, it must be in line with the policy's terms and conditions. For example, if you consider a critical illness claim, many people think, well, I've had a heart attack or I've been diagnosed with cancer. That is sufficient. That mere diagnosis is sufficient to lodge a claim. It's not. Heart attacks, there has to be certain requirements that have to be met. For example, a skin cancer or many stage 1 cancers are not necessarily covered by a credit life insurance policy. It's very important to read your policy to make sure what the terms and conditions of that policy is. The reason for exclusions, there's nothing wrong with an exclusion in itself. It is to hedge an insurer's risk. It's to make sure that, you know, they don't just give insurance to people without limiting their risk. So there's ways that they manage this risk. And the risk that I'm talking about is the risk that an insured event happens. An insured event would be death, disability, critical illness, or loss of income. So they've got three main ways of managing this risk. And it is either by putting an exclusion on, saying that they won't cover certain conditions, by a qualification, saying that, for example, suicides will only be covered after the policy has been in effect for about 12 months. Time clauses, so that would be like waiting periods, or that, so they'll only pay a claim within after the expiry of a certain period, or a benefit won't be applicable after you reach a certain age. And then there can also be specific conditions that they will apply onto the policy. So with regards to waiting periods, so basically a waiting period kind of suspends the insurer's liability to pay a claim. So the claim might be valid. You know, there might be a death claim and it's a completely valid claim, but because the waiting period is applicable, in the time that the waiting period is active, a claim will not succeed. It is usually in credit life insurance, it is applied to death benefits, specifically to suicide. So within the first year of a policy, a suicide claim will not be considered, and also to retrenchment benefits. A lot of insurers limit or put a waiting period of 3 months on retrenchment benefits. So within the first 3 months of the policy, if you put in a claim for a waiting period, your claim will probably not succeed if there is a waiting period on that policy. It is important to remember that it's a date of the insured event. So the date that somebody commits suicide or the date of the retrenchment is important. It doesn't help that you only put a claim in, on month 4, a retrenchment claim on month 4, but the retrenchment took place within the first 3 months of the policy. Another way that they limit the risk is to put age limits on a credit life insurance policy. So usually you will not be able to claim retrenchment or loss of income benefits and also sometimes disability benefits after the age of 65. Again, it depends on the policy. Some policies say disability will not be covered after 70. Some even say death won't be covered after 75. It's very important to read your policy and to know what is applicable on your policy. The reason for 65 was that the age of 65 was considered the normal retirement age. So it would be a bit disingenuous to claim retrenchment benefits after you've retired, for example. Another way that insurers limit their risk or just manage it a bit is that they may limit the monetary value of claims. So let's say you bought a car and you financed a vehicle, and the outstanding balance of that vehicle is 150,000 Rand, but the policy only provides for maximum cover of 100,000 Rand. The insurer will only pay the 100,000 Rand. They won't settle the full outstanding balance. You as a consumer will then be liable for the other 50,000 Rand. And then one that's quite well known is pre-existing conditions. So credit life insurance is not, well, in a lot of cases, it's not like taking out a sole life policy where they underwrite you, where you have to go for medical examinations, they send a nurse to you. It doesn't happen like this in credit life insurance. Credit life insurance is usually taken out the credit providers' offices, or their branches. So there's usually not a nurse available to draw blood or, to take your heart pressure. So to kind of manage that risk, they will put in a pre-existing condition exclusion on. And the reason for that is just to make sure that somebody that is very sick and he knows that he's probably going to pass away soon doesn't take out credit, but with a credit life insurance policy, knowing that he will die and will not be held liable for it. Same with disability. So usually, and in most cases, it's a 12-month period. So if you have a medical condition within the 12 months before you take out the policy, and in the first 12 months after you've gotten the policy, you become very ill, so ill that you become disabled, or that you pass away from that, the policy will not pay out. So, but it's only limited, the condition is only excluded for the first 12 months of the policy. Usually, again, it's important to look at your policy. If you then, let's say, for example, you had diabetes. You died diabetes in 2018, you took out a policy in 2019, and you pass away now this year in 2021 due to diabetes, the pre-existing condition exclusion will not be applicable because it's past the 12 months period. But again, very important to read your policy and to know exactly what you are covered for and what you are not covered for. And then finally, there's some general and common exclusions. The most general ones are, that the insurer will not cover an event that arises from your participation in a criminal activity, or if there was a war, or if you were driving under the influence of alcohol or drugs. With regards to driving under the influence of alcohol and drugs, we've had quite a few interesting cases. So we are of the view that there has to be a link between you driving under the influence and you passing away. If there isn't a direct link between those two, then the exclusion shouldn't fly and the claim should be paid. To qualify retrenchment benefits, there's sometimes some common exclusions placed on that benefit. The reason for it is usually to avoid situations where a person played a role in losing his job or where the end of his job was foreseeable. For example, you can't resign or retire or take a voluntary retrenchment package and then claim for retrenchment benefits. The whole aim of retrenchment benefits is to assist you when you lost your job, but it was not your fault. So Misconduct, obviously, as well. If there's been a disciplinary hearing and you've been fired, you can't claim retrenchment benefits. Again, and I will always say it, it's very important to look at your policy and see what exclusions are provided for. And then another reason why why credit life insurance claims are declined is because the policy has lapsed. In the beginning, I advised that there's two different and very distinct agreements in place. You've got the credit agreement on the one side, and then you've got the credit life insurance agreement on the other side. Whilst the credit agreement can stand separately from the credit life insurance policy, the credit life insurance policy is dependent on the credit agreement. For the simple reason that the credit life insurance premium will be added into the credit agreement installment. So when you pay your credit installment, when you pay for your car or your house or you pay your loan, the insurance premium is included in that installment. So what happens is if you miss an installment, you're going to miss your premium as well. And because credit life insurance is like any other insurance policy, the moment the premium is missed, your policy can lapse, and the moment that lapses, you have no more benefits. So it is very important to make sure that you pay your premiums. The responsibility ultimately lies with you as consumer and with you as policyholder to make sure those premiums are paid. Without premiums, there cannot be any cover. Specifically with debt review, in some instances, either the credit provider or the debt counselor doesn't make provision for the credit life insurance premium, and it will then lapse. So tips, the most important always is to read your policy. You cannot claim for something that you do not know that you have. It's very important to know exactly what exclusions, age limits, waiting periods are applicable. Also, the law provides that you must be able to substitute your credit life insurance policy that a credit provider offers you with one of your own. Of course, it has to have the same benefits. You can't say, well, I've got a life insurance policy, but it only covers my life and I want to use that for credit life insurance. No, it will have to have the same benefits as the one suggested by the credit provider. And then another matter that's important to remember is inform your family members that you have a credit life insurance policy. If you pass away, the last thing you want is that your family members have to pay your outstanding balances, or that a vehicle is repossessed or a house is repossessed, and meanwhile there was credit life insurance on that policy. So that is it. Please feel free to contact us with any queries, concerns, complaints. We look forward to hearing from you.